To order. I need a motion to adopt the agenda for today.
So
Second.
It's been moved and seconded. All those in favor indicate by saying aye.
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 We also need a motion to approve the minutes from December 8th.
So moved. Second.
It's been moved and seconded. Is there any further discussion on those minutes? Did you have a chance to read them? All those in favor of approving the minutes indicate by saying aye.
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 Any opposed? Chair votes aye as well. This is time for public comment. We have one person from the public here. Would you like to say anything at this point?
No, I think that I'll be presenting in a minute.
All right, thank you. Anybody else? No Diane yet. Okay, then we'll move on to the Board of Investments annual report. Oh, hold on just a minute. I forgot to mention this. I have to always read this. This is an opportunity for the public to comment on any public matter that is not on the agenda of the meeting and within the jurisdiction of the Teachers Retirement Board. However, the board may not take action on any issues raised unless it's included on the agenda and public comment has been allowed. If issues are raised that would require board action, the issue would need to be included on the agenda for a future meeting. Public matter does not include disability applications or contested cases or other adjudicated proceedings. There. Now we're ready for the Board of Investments. I'm sorry.
Oh, no problem. Good morning.
good morning.
Thanks for having me back and an opportunity to give you an update on the investments through the end of December. Hopefully everyone has in their packet a presentation to the Board of Investments and investment updates. I was going to spend about a half-hour presentation, but please, as I go through, ask me any questions that you have. It's really, if we turn in the presentation on page 3, you'll see somewhat the outline of topics we're covering. I want to cover kind of the investment goals that we think about, asset allocation, what the performance has been, how both the asset allocation and performance compares to peers. And then just a little bit about the current economic environment and state of the markets and how we're thinking about things going forward. And again, whether it's in between here or at the end, if there are additional topics you want me to touch upon, please don't hesitate to ask. So turning to page 4 of the presentation and to discuss the investment goals. The first bullet point here, the Unified Investment Program, the key thing is we need to act as a prudent expert. And the 3 items below it describe, well, really what that means. And so we need to, every day, think about things and take care, skill, prudence, and diligence. So that is, think of all things that could happen and act as the point 3 here says, solely in the interests of the beneficiaries of the plan. So we're not taking actions based upon our personal risk preferences and what we think is best. We're acting solely in the interests of the plan. And also point 2 here is important, diversify holdings. So we're not looking at things and saying, what do we think is going to do best, and go all in there. We're approaching it from a total portfolio standpoint and diversifying holdings to achieve the goal. The second bullet point addresses the investment performance. And number 1 there is the actuarial expected investment return. For TRS at this point, it's 7.75%. So we're aware of that and striving for that, but of course that as the actuaries have pointed out, is over a very long, multi-decade period of time. Shorter periods of time, we're also monitoring the performance relative to investment benchmarks. And what that means is, like for equities, we'll have a benchmark and we'll see how did we do against the broad set of equities, and same thing for fixed income, we'll have a benchmark and so forth. And then last, we will look at other peers. This becomes a little bit more of a challenge because we can see their numbers, but we don't know exactly everything that they're doing, and we don't know the details of their goals, so it's not as much apples to apples, but it's important for us to pay attention here, and we'll be covering this today to give you a sense of how our returns and allocations compare to them. Any questions on the goals? Page 5 here, hopefully this isn't too difficult to read, but just want to give you a sense of the organization. The Board of Investments itself, the full-time staff, day-to-day, led by Executive Director David Ewer. We have 32 people, and so it's a sizable organization. There's 15 people on the investment side that are focusing on the investments each day, and then you'll see to the right the loan programs and the financial manager, the accounting that's done each day. And of course, we are reporting to a 9-member board that forms the Board of Investments. If I could ask you to turn to page 6, I will briefly review asset allocation. And you've probably heard many times the asset allocation is the primary driver of returns. It's not the sole driver, but because it's kind of the top-down decision that is made, and we're deciding, well, how much should we have in cash or fixed income or equities, it is the primary driver of returns. And so as we think about the asset allocation going forward, a key component of that is coming up with capital market assumptions. So what do we expect for each of these asset classes? What do we expect as their return, and how volatile will those returns be, and how will those returns go up and down compared to the other asset classes? And a lot of that work is done for us, and thoughts on that topic by our external consultant, RVK. And so once a year they update their thinking. There's not big changes year to year. It tends to be pretty incremental, but it's important for us to talk about it once a year. And the key thing to understand, I have this in bullet point 4, is volatility of returns reduces expected returns. So what that means is if returns kind of don't just stay flat for a long period of time, but go up and down, and I'll have a slide later on to show this, but if you have a negative return, you need a more than that amount positive return to offset it. And so as returns tend to go up and down, that does reduce overall the expected compound return over a long period of time. The 5th bullet point here, and this is very important because ultimately these plans are made to pay out and support the benefit payments that the board is making. So that is going on a regular basis, and so liquidity must be available for that all the time. It's very manageable at kind of current levels. It's not a problem, but it's something we need to be aware of. And so we have a few percent of the portfolio just invested in cash. Be ready at all times as you pull down and disperse those benefit payments. And the last point I want to touch on this page is asset allocation can be very kind of technical or mathematical, and it's not just one way. So it can seem, I guess, very scientific, but it's also a little bit of an art, because it's these assumptions you make to put in the model. They're not always perfect. They're not always going to come true, and so we, working with RVK, the consultant, we try to take a few different approaches in thinking about this to determine the asset allocation. Any questions on asset allocation?
Joe, I have one.
Yes.
In the last annual analysis that you got from RBK, were there any substantive changes in their capital market analysis going forward? For example, allocation of bonds to equities, or what impact for certain declines recently in real estate may cause?
Sorry, that last part, certain declines in real estate?
Real estate investment trusts have been performing very poorly by contrast to other asset classes.
Okay. Yeah, so a few things. So RBK and most institutional consultants, investors look at asset allocation and are mindful of what's happened in the past in returns, but are also kind of looking forward. So in some cases, the higher returns have been recently, that dampens the return going forward. And the lower, that might provide some reason to think, well, if things revert to the mean, the returns might look a little bit higher going forward. So they will be updating the board, RBK, at our April meeting with their most recent capital market assumptions and their thoughts on asset allocation. And so they're in the process of fine-tuning that at the beginning of the year. But last year, the view was interest rates had continued to come down and were pretty at low levels. So their expectation for fixed income had come down a little bit, looking forward the next 10 years. Equities also had come down slightly because they've done very well recently. And they were, fairly valued to maybe a little bit fully valued. Specific to real estate, we can invest in REITs, which are in the public market. We're also investing in other types of real estate investments, and they had done very well over the last 5 years. So there was an expectation that those returns going forward would be influenced more by the income that real estate puts off and less by the capital appreciation. So the overall return expectation was a slight decline from the previous year. But I can come back and update you with their recent thoughts. My guess at this point would be we've seen interest rates go up now a little bit, so maybe some of those numbers increase going forward. My guess is on equities and real estate that their numbers stay pretty stable this year because they're looking forward the next 10 or 15 years.
Would you expect any kind of substantive shift in exposure to international or emerging markets?
Not substantially. I think on the margin, we've been slowly adjusting and adding a little bit more kind of international. We've always had a U.S. bias in equity and in fixed income, public and private assets, and I expect that to continue. But on the margin, we are, on both the public and private side, adding a little bit more international, including the emerging markets.
Thank you.
Sure.
Joe, can I add one thing real quick? So as soon as those new capital market assumptions are available, we'll provide those to our actuary, and they will take those into consideration for the experience study that's currently underway.
Okay.
So at our May board meeting, Kavanaugh McDonald will be here and will be presenting the results of the experience study. I mean, I have not even seen a draft of it yet, but it's underway and it will be ready by May. And part of what they use to make a recommendation on the assumed rate assumption includes those updated capital market assumptions.
Right. Thanks.
So turning to page 7, just a few more thoughts here on asset allocation. A few things that we want to consider are the funding objectives, again, back to that assumed actuarial return, the current characteristics of the retirement plan, anticipated changes, of benefits and contributions. So as you consider changes there, that potentially has impacts on what we would do. And lastly, the opportunity set of investments. So that's thinking about these asset classes that have been around for quite a while and some of the newer asset classes that have been incorporated, say, over the last decade or so. So we're always looking at the opportunity set. currently, you know, those numbers I just shared about the recent thinking from RVK, as we look forward approximately about a 10-year period, our expectation on those assets is in terms of an expected return, is below the actuarial return, but that is not really concerning because they're two significant time periods. You know, we're looking at 10 years out, and the actuary is looking at 40 years out, and so it's not a concern, and things, you know, do evolve over time. So I just wanted to point that out.
Joe, how big is the difference right now?
It's about 1%.
About 1% or so?
Yeah, so it's, so again, a fair amount of that is driven over the last several years. The interest rates or yields on fixed income investments have come down to historic lows, right? And so that has significantly influenced that number to be 8% below, but the plans have benefited from that, because as rates go down, the value of bonds go up, right? But over, as we sit here today, and literally year to date, interest rates have gone up, you know, a good amount, and I'd say not a full 0.5%, but approaching that, and so they're not. The key point is they're not inconsistent, even though the assumptions today for RVK over a 10+ time frame and the actuary are different. They're not inconsistent. Point 3 I've already addressed, but we just don't think about it. We also review and approve the asset allocation on an annual basis. For us, that takes place. It's somewhat of a year-long process. We'll hear from RVK towards the beginning of the year in the April meeting, but the formal review for us takes place in November. Now, we could, if something happened drastically during the year, we you know, could go back to the board and change before that November. So it's not, the calendar doesn't force it, saying that's the only time we can look at it, but from a discipline standpoint, and make sure we look at it at least once a year. And just the view from the recent November meeting, a few small changes. We again, for our asset allocation, I'll show this in a minute, we utilize ranges for each of these asset classes. And so there were some changes on those ranges. So we increased the top of the range from international equities from 18 to 24%. The reason there is we were close to 18 and we were moving that direction increase. And so as we look forward, we do think, as we were just discussing, the international exposure will probably increase in the portfolio. And so that was something that was recommended and approved to the board, to change, increase that upper end of the range. And then a small change, part of our fixed income component is called broad fixed income. It's the smallest component of our different fixed income asset classes, and we decrease the range, the bottom end of the range from 1% to 0. So nothing really significant, pretty consistent overall asset allocation from the previous year.
Joe, a couple questions. Are the ranges what the board approves, or does the board approve to the percent what the allocation should be each year?
Yeah, no, that's a very good question. The board approves the ranges, and there's a number of reasons for that. You know, markets move around quite a bit, and in different parts of the markets don't always move together, right? So the smaller asset classes, and I'll show the ranges in a minute, but where we are in some of the smaller asset classes, their percentages is influenced as much by U.S. equity, which is the largest asset class. Because if U.S. equity goes up a lot, chances are the other smaller asset classes will go down a lot. So we don't want to always kind of force things just because other things are moving, so there's an ability to recognize that things are gonna move around, and so that's why we use ranges instead of precise targets.
What if it's a more purposeful move as opposed to the markets moving? What if you say, we have a range, we're able to go to 24% international equities, we're gonna make that move
So
without a board approval?
Yeah,
Is that
so
fair?
we would, staff has the ability to kind of make that move.
Okay.
But we do have meetings on a quarterly basis, and chances are it wouldn't be from 18 to 24, it would be from like 18 to 19, and so we'd be talking about that, why we did that with the board, and as we went forward, and you know, to make go from, just as an example, from 18 to 24, you know, that's about a overall 30%, you know, move. We'd probably have a course of a few different board meetings, updating the board why that range was increasing and why we thought there was a benefit to that. But staff does have the ability to work within those ranges.
Has RBK made any commentary at all recently on the growing correlation between the movements of stock prices and bond prices? Because, you know, 30 years ago, obviously, that assumption was very clear that they would be uncorrelated in old theory, but now that's proving to be far less the case. And has that been addressed in terms of the range of percentages that each of those asset classes would comprise? Would comprise?
Yeah, it is part of it. So on the prior page, I didn't go into a lot of detail, but a sub-bullet, part of those capital market assumptions is the expected return, there's a volatility, and there's the correlations.
Right.
And so those correlations are important. And you're right, over different periods of time, different asset classes like equity and bonds have been less correlated. More recently, they've been more correlated, and that is taken into account with their assumptions and with the asset allocation. Also, just from experience, we know when things go really bad, everything correlates, right? So sometimes sometimes that's the simplest assumption to make is assume when things go bad, you know, there's not going to be truly any place really to hide, and so they're important numbers to think about, but we also think about those worst case scenarios when those low correlation numbers may not prove true, and so we're managing the portfolio with that in mind.
Just a quick follow-up to that. Has the board ever utilized or considered the use of any kind of hedging strategies?
You know, hedging is, that means different things to different people.
Yes.
Some people would say, well, we have bonds and we have a small allocation of cash that hedges equities, right? So we do that today. We hedge because we select both active and index type of approaches, and each of those are managed by different managers. So that's a hedge because the different managers use different styles. So there's a lot of different types of hedges already embedded in the portfolio. But if your question is in terms of using like a derivatives overlay type of hedge, you know, or buying put options, you know, to protect kind of the downside, there has been discussion on that, and it's considered, you know, sometimes, but it's very time sensitive. It's a very expensive approach, because if it weren't, everyone would do it, right? And it's expensive because enough people do it to a certain extent and buy that insurance and gets priced up such that over time, if you always did it, it probably wouldn't be helpful. And so we look for periods of times, and when we think risk is getting greater within the markets, within the portfolios, we look to diversify more, put on some types of hedges, and some of the managers could utilize some of those type of, utilize some of those derivatives. But on an ongoing basis, we don't currently use an overlay to always protect the downside of the portfolio because it would be too expensive to do. It would take away too much from the return.
Okay, thank you.
Sure. Okay. So turning to page 8, just very quickly, teachers here, and a number of these slides I just pulled out of our board presentation that we just made a few days ago at the Board of Investment. So apologies, they're not all geared to teachers, but I think there's some benefit there to give you comfort that the teacher's plan is also being managed in a very similar way as these other plans. So on this page, teachers, the second line, you'll see that the overall allocation, 2.1% in STIP, so that's the cash, such that you can pay the ongoing benefit payments. And the remainder, the 97.9% is in CAP, which is this consolidated asset pension pool. And if we flip the page, what's in CAP is all these underlying asset classes. So CAP is this consolidated pool that holds each one of these asset classes as separate funds. And so currently we're investing in these 12 different asset classes you see on the left. You see the market values you see on this page for the overall CAP include not just TRS but all the plans. But specific to CAP, you see the actual percentage, so domestic equities 35.4% as of December 31st. And to the right, you see the board-approved ranges that we had talked about before. So all the asset classes are within those approved ranges. And down the bottom, we want to ensure that there's always some fixed income because that is somewhat like that hedge protecting the downside. And so we have a minimum of 15%, and as of December 31st, we had 25%. And that's not that big of a change from where it's been. We've roughly been in that 70 to 75% type of equity exposure and about 25% fixed income. If we flip to page 10, you'll see the return. So teachers is again the second line here, and extremely strong return for the 1 year as of December 31st, 14.76%. It's an exceptional return. It's not something to again expect every year, but it is returns like that help achieve over a longer period of time the actuarial return. As you look over the last 3 and 5 years, still very strong returns. The 10-year return at 590 and the 20-year return 648 are both below the actuarial return, but both of those, especially the 10-year return of 590, was significantly influenced by markets going down in 2007, 2008. So probably next year, a year from now, doing this review, that number will look much better as some of those bad months kind of drop off. The good thing is to the far right, the since inception return of 7.85 is very consistent with the longer term actuarial returns that the plan has made. So it's a good story. As I mentioned earlier, the higher the recent return, somewhat the more difficult it becomes in the next period. But things have been very good recently. On page 11, and again, this may be difficult to read, and if you try to read some of these words in each of these boxes, it may not make sense. I'll just let you know each of the words are the abbreviation for the benchmark that's used for each of the asset classes. So for example, the top box far left it says MSCI ACWI, All Country World Index. MSCI is Morgan Stanley, that's where it originally came from. So it's the All Country World Index X USA. So this is basically a benchmark that represents international equity securities. That was the best performer of last year. Right below it is the U.S. component of that. And so U.S. also did very well, but not as strong as international. And And the fourth box down where you see PERS, that's where TRS also is right on top of that. So that's what we would expect. You would expect TRS in each of the retirement plans to be in the middle here. It's never going to be at the top because we have a diversified mix of asset classes, and so it's going to be in the middle. But the important thing to take away on this slide is you never see the colors, or very rarely do you see the colors in the same place, right? And sometimes things that are at the top can be at the bottom in another period, especially if you look at this not over these longer periods, but year to year. And that's why we use multiple asset classes and have diversification. So more important is the visual takeaway that, the things are moving all over the place. And that's the reason why we don't try to sit down at the beginning of every year and say, what's going to be the best asset class, and put all our dollars there, and then try to do that again the next year. Any questions on this page?
If you were actually able to do that and you were right every time, you would have passed.
And I probably wouldn't be here.
I had a quick question on that, I'm sorry.
Yes, please.
So in the RBK reports that we get monthly, the
This is-
benchmarks are like a pack custom blend or
Yeah.
something like that. How come those aren't correlated with these benchmarks that are showing? Are they?
How come they're not correlated?
Well, they're not the same benchmark. I guess.
In most cases, they are. In most cases, they are. So the ACWI XUS is our benchmark for the international. But what you see on the report, because it says custom, is that a number of years ago when we switched to this benchmark, there had been a benchmark, back in the 90s that was different. So we linked those two benchmarks together, and so that's why it's called custom.
Okay.
But it is utilizing this benchmark, which is the current benchmark for each asset class, but it may have changed in the 20-plus year history.
So they're similar, just not the same name, basically, or that are showing here on page.
So in the report you're looking at, sometimes we call it a custom benchmark. It's custom because we're using this same benchmark now, but as we look over longer periods of time, we're combining it with the benchmark we had years ago.
Okay.
And so we don't want to put just this benchmark on that report, because 20 years ago, or even 10 years ago, we may not have used that same benchmark. So that's the reason that it's slightly different, and that's why it's saying custom. It's combining the benchmarks that have been used over time.
Okay.
Happy to go maybe after the meeting,
No, that's
go
fine.
into
That's
greater
fine.
detail and
Sounds.
answer questions you have. So on page 12, the teacher's second line here, you'll see the 35.8%. That's represents our total retirement assets that we're managing, which in the next column, teachers 4.1 billion. This is as of 12/31, compared to the 11.5 billion in total. The important thing here is the far right. If you read across the teachers column, you see the change was slightly more than, it was an increase in value of more than 400 million over the years. So very significant, very, that's more important than that 14% number is the dollars associated with it, because it's the dollars that we pay the benefit payments with.
And that was actually net of expenses, correct?
Yeah, it's net of all expenses, fees, it's actually net of what we'd call the net cash needs. So on every month, money's coming out. So it's net of the benefit payments we paid last year too.
Which was 320 million, something like
Yeah,
that?
just a little over that,
Yeah.
330.
If no questions on that, turn to page 13. There's a lot of detail here, peer comparisons, and this report comes from RBK. If you can look from the top chart is comparing performance, and if you look kind of three things down, you see teachers' retirement net. Those are and if you go 3 columns in, you'll see 14.76. That was a number I mentioned just a few slides ago as the 1-year return. And as you read it, keep reading it across, you'll see 9.74 is the 5-year return, 5.9 as the 10-year return. Those are the net returns, net of fees and expenses for the plan. Just below that, it says teacher's benchmark. That is a benchmark that is being rolled up from these different asset classes and saying if we could invest in all those benchmarks immediately with no costs, no fees, what would have we done? So the number last year, 15.32, our actual performance was 0.56%, or what we'd say 56 basis points behind the benchmark. Some of that is because in each of these asset classes we hold a little bit of cash, and we, in implementing the portfolio, don't have the luxury of not paying any fees like the benchmark will pay some fees, and so although it's not above the benchmark and it is below, it's still a very good year. Then if you read below that, the next section, you'll see teachers' retirement gross, right? So again, using the 1-year number, 15.31 gross means we're removing fees, So that's why the 15.31 is higher than the 14.76, because we're looking at it before fees to compare it to other plans. And so below teachers' retirement gross, we say all public plans greater than $3 billion, and we look at the median there, and the median was 16.08% for the year. So we were slightly below the median for the 1 year, and right below that it says rank, and it gives a number 65. So we're in the 65th percentile. So right at the average would have been 50, 65. It works the other way here, so a little bit higher number here is a little bit less attractive. So a little bit behind the average. But more important to us is you go out to the 5-year and you look at the 10.26 return for teachers and the 8.84 for that peer group. You'll see we have a number of 3. So that means we, in terms of performance over a 5-year period, we're in the top 3 percentile, right? And 7-year top 1 percentile, 10-year top 9 percentile.
And how long have you been there?
Me? Oh, I've only been there a little over 2 years, so I am not taking,
So far a low correlation with that performance, or high recently?
I feel good about the performance since I've been there, and most important, the process, and I feel good about what I came into, right? I think it was an excellent team, excellent process, and excellent history of demonstrating good results. So, but the key thing is over a period of time, not just because right now those look more attractive, but it's our longer term objective. If there's no questions about performance, I'll talk about the peer comparison and asset allocation in the bottom, and that will give some explanation why the 1-year number is maybe in slightly below the peer median.
Before you move on, can I ask you a quick question for my own edification about history? So this goes back, I assume, the CAP program, 23.5 years.
Well, CAP itself is new as of last year, but the unified program, what we're doing, the since inception numbers go back to when we had State Street as a master custodian, so that goes back to 1994.
Okay, and previous to that, they were responsible, so we're using different numbers.
Previous to that, when you say they were responsible,
well, okay, so teachers' retirement system has obviously been around a lot longer than 23.5 years. I'm just wondering.
So is the board, but for a period before that, and assets were being managed internally, and so the reporting was different, and so because the data was much cleaner when we moved to State Street and started using that. That's, I think for quite a while has been used, that 94 as the inception date of those numbers. And at this point in time, things before 94 aren't really as relevant. So
Understood.
for us to look at a 20-plus year history, you know, we feel that's good enough.
Okay.
So if no additional questions on performance, the bottom chart here is really about asset allocation. And so if we look at the first column in US equity, you see the numbers at the bottom and a graph above that. And the graph above that, there's different shades of gray. Each shade represents the quartile of managers. Now this isn't performance, this is asset allocation as of 12/31. So if you look right under where it says US equity, 35.43, that's the percentage we had in US equity as of 12/31. That is in the 21st percentile, which in this case, that means it was towards the higher end, and so you can see a little green diamond in that top lightly shaded gray box, so we'd be in that top kind of quartile of plans, right? And so we have more US equity than 75% of the plans in this peer group. And then if you look just to the right in international equity, it's almost the reverse, right? Everyone has a little bit more US, not everyone, but we have significant more US 35 than international, which we had 18. But on a peer basis, we were on the 71st percentile. So that puts us in that third quartile, and so why you see the diamond in the third shading. And that difference there is the biggest explanation for the one-year return. Because over the past year, if you remember to that periodic table I showed you with all those colors, international equities were up about 27%, and US equities 21, 22%. That difference, and we had more US than non-US, is why compared to this peer group that had on average more non-US than we did, why in the one-year period they did better. That difference has stayed pretty, the magnitudes have changed, but we have been towards the higher end relative to peer group in US equities for quite a while, a number of years, and that's benefited us, and that's a meaningful reason why over the longer time period, like 10-year period, why we're in the top 10%. So again, it won't always be the case. It has been. It's benefited the plans. Last year it hurt relative to peers. It didn't hurt the absolute return. We're still up, more than 14%. But as we look forward, is one of the reasons where we are marginally increasing some of the non-US equity exposure and slightly reducing US equity exposure. So I'm not going to cover each of these things, but you can look across and you can see fixed income. We had 25%. That's in the 26th percentile. You can see that if you look above at the graph, that's one of the areas of biggest dispersion. Some people had more than 50% of their plan in fixed income, right? And last year they would probably have been the lowest performing peer, right? And but that's why it's difficult to look at peers. That might have been the best allocation for that plan given them their circumstances and what they're trying to do. So it's not as much apples to apples. But we try to learn from it and kind of ask questions. Why would someone have much more fixed income, much more equity, much more international, and say and ask ourselves, challenge ourselves, should we be changing?
Do you have a sense for small cap versus large cap between us and peers, or is that not reported?
It's not reported, but our bias is to have a little bit more mid and small cap over time than large cap. So I'm both in US and non-US, but my guess is that we have a little bit more mid and small cap.
A little bit about last year too.
And other plans, yes, correct. But also over a longer period of time, because mid and small cap has done better, that's another contributor to maybe why we've done better than plans over a longer period of time. So, you know, the one other thing, just to clarify the, what is it, 1, 2, 3, 4, fifth column over alternative investments. For us, that's our private equity portfolio. For some others, that may include a top-down allocation to hedge funds. Really, it's any type of more private investment that isn't, say, real estate, which is the next column. And, but I would say very much with peers, kind of in line in terms of most of the peers' overall equity fixed income risk, but the mix within equities and fixed income is different, and that's why the returns differ both over the shorter and longer periods of time.
Joe, 25% or so of your allocation in fixed income, or you're in that percentile.
Yeah.
Are you contemplating any shifts in the style of fixed income? You know, some fixed income debentures and senior loans benefit from rising interest rates, and obviously bonds do not. So who are the managers there? What kind of structural changes are you making in fixed income?
Sure. So maybe to answer that question, if I could I ask you to flip back to page 9, which shows the asset allocation, right? And so, so if you look on page 9, if you look at the asset classes and where it says TIPS, that stands for Treasury Inflation Protected Securities. So that's a fixed income security issued by the Treasury, which tends to do a little bit better than nominal treasuries if inflation goes up. But every one of the other asset classes between TIPS and high yield, we consider fixed income. Now, high yield and broad fixed income, those are managed externally. All the other TIPS, U.S. Treasury Agency, investment grade credit, and mortgage backed are managed internally. Those are all investment grade, high quality type securities. So one change we did make last year is we previously, for quite a few years successfully, had used a more broader fixed income benchmark. So we didn't, that combined the Treasury Agency, the investment grade credit, the mortgage backed, and the high yield all into one. And a number of other peers still do that, and it's the benchmark there usually combined against is the what's called the Bloomberg Barclays Aggregate Index. It has all types of investment grade fixed income. We broke it apart, and these components are more intermediate components. They're not, so they're shorter in maturity, less sensitive to interest rate moves. So last year, we moved it to be less sensitive to interest rates because we were at historic lows. Could have we gone lower? Sure. I think the overall market was surprised how low rates have gotten the last few years. But historic lows, we don't think we're going to have negative rates. So strategically, we moved our portfolios to securities that were a little bit less sensitive to interest rates. And so we are thinking of those things, and to a lesser extent, we use floating rate securities that you were talking about. But we are mindful of what can happen in the fixed income markets as we look forward and the risks of a quickly rising interest rate environment. Does that answer your question?
Yeah, completely. Just one, on the mortgage-backed securities,
Yeah.
are you, is any significant portion of those variable rate?
No, not significant. The vast majority is all agency, U.S. residential, 30-year
Right.
fixed income mortgage-backed securities.
Dependent.
Yeah.
Okay. Thank you.
Sure. So no, going a little bit slow, so maybe I'll speed up. Page 14, again, the performance takeaways that we were just talking about. You know, strong absolute returns in recent years. The longer-term return, 7.85%, you know, since '94, is very consistent with the assumed actuarial return. Peer performances can be explained by those asset class differences, whether you're looking at the 1-year or the 10-year period. And actual results do differ, deviate year from year from the longer-term assumptions, but it doesn't mean the longer-term assumption, we know that's gonna be true. We know we're not gonna have a flat, 7.5%, 8% type of return over time. We're gonna have those ups and downs. I'm gonna very quickly go over the economic environment, so slow me down if you have any questions, but on page 15, this expansionary period we're in on the left-hand side is as of the time of this report at the end of the year, 102 months, one of the longest periods. And there's no reason for us to believe that expansion is gonna stop this year. So we think that will continue this year and be one of the longest periods. The difference here is that the growth during that period each month is a little bit less, right? And maybe there's a benefit of that. It's not a go high quickly and then have a recession. It's gradual growth, so we're benefited from that. Page 16, another positive story, the unemployment rate. So look at the black line here. The black line, you see in October 2009, after the crisis, was about 10%. High level, 50-year average, 6.2%. As of November, 4.1%. As of the most recent reading for the January timeframe, still at 4.1%. So unemployment is at a good level and likely to continue, maybe even get a little bit lower before it goes higher. The surprise is that there really hasn't been as much pressure on wages at this point. We would expect that when unemployment gets to this level or lower, to see the wage growth, so that's that blue graph at the bottom, to be coming up a little bit more than it has. And so that's something people are really focusing on, because if that happens, it's more likely that we'll see more inflation, and inflation has impacts on our investments. Speaking of inflation, next page is just one measure of inflation, the Consumer Price Index, and you'll see this over time. If you look at the headline number, the light blue, the difference between that and the dark core kind of takes out food and energy. But the most recent number on this report was 2.2% in November. As of January, it was 2.1%, and the core 1.8%. So not changing a lot as we go into this year. Inflation is still low. The Fed is targeting about a 2% inflation, maybe a little bit higher. They basically want as many jobs as we can have without having inflation go up a lot. And so they're comfortable with a little inflation, but they want to avoid everything, to try to get back to inflation that we saw in the 70s, double digit. So on page 18, baseline assumptions, continued global economic growth, but at modest levels, full employment, inflation near kind of Federal Reserve targets. What that is causing on page 19 is the Fed is gradually starting to increase rates after their quick decline in rates in the 07-08 period. And this is a good thing over time. One, because this will have a direct impact on people seeing a little bit more higher rates on their cash investments or in their checking accounts, or as we have cash within the plans. But it also, longer term, if rates go up, it allows the Fed a tool to lower rates the next time we have a recession or something like that. So it's a positive thing that they're gradually increasing them. And you see these lines, the Fed expects, as we go through this year, they're likely to increase rates a few more times, but still very, very gradual. And then on page 20, this is further out the yield curve, the 10-year Treasury yields. The blue line here is the nominal yields. You'll see in 1981, 15.84%. Boy, we wish we could invest at those levels today. It'd be easy to get these actuarial returns. But the decline to 2.40 as of the end of December, not historic lows. We reached that a little bit earlier, but pretty close to it. But as of today, we're at 2.86. So since December 31st through today, we've gone up, 46 basis points. That's a meaningful move in that period of time. So, so something that we're keeping an eye on. The next page is showing the S&P 500, which are representative of the largest U.S. equity holdings. And here you see that it has gone up, and it's continued to go up. This year it went up very quickly during January, and then it had a correction. As of today, it's at 2,726, which is up approximately 2% year to date. I'm going to skip the next page, page 22. That again is just showing the S&P in terms of relative value over time. In the last page, I want to talk about in terms of this economic stuff strategy. Is page 23. This drives home the point why we're in equities over a longer period of time. We think that is where the growth and the appreciation, that's how we will achieve these longer returns. And so you see over a 20-year period being in stocks, it's really benefited instead of being in the safe investment of cash. But to the right, you see the importance of also protecting the downside. It's not, it's pretty symmetrical. If you go down 5%, you need a 5% positive return to get back to even. But go out to down 10%, now you need an 11% return to get back to even. If we go down 40%, equities go down 40%, so that was similar to what happened in 2007, 2008. You need a 67% return just to get back to where you are. So it's why we are in it for the long term, why we have a bias towards equities as our strategy, because they have, and we believe over the very long term they will do the best, but it's why we need to be diversified and also mindful of what during some very challenging market periods, if markets go down significantly, it takes a lot of work just to get back to where we were. So on page 24, the strategy is the ranges, and we've talked about that a little bit already. Valuations matter. It's not just we're always looking, we're saying, just like you do with any purchase you make, is that a good buy, right? We're doing that on equities, fixed income, cash, and we're adjusting those purchases and those allocations based upon our opinion. Do we think it's a good buy, or are we better sellers? Our focus here is to continue to improve overall diversification, and so that's why you probably will see our U.S. equity allocation decrease over time as we put more dollars in some of these other asset classes. But longer term, we will have maintain this equity bias, because that will be the key to getting the long-term actuarial return. And then lastly, on page 25, of course, asset allocation remains critical. Of course, day-to-day, we're acting as prudent experts. Although there is no right asset allocation, there's what we believe an appropriate one for the characteristics of the plan and the current markets, and that's what we think we're implementing, but that will lead to changes over time. There's quite a bit more information available on our website, and with that, happy to answer any other questions.
I have one other subject to bring up before you leave.
Sure.
As I mentioned when you came in, John had sent us a copy of an article by a legislator in Bozeman talking about his opinion, the inefficacy of defined benefit plans like this, and stating some examples in there, namely that I think he's quoted in the article that it's only 63% funded, and that was a reason for large concern. Is there any representative from the Board of Investments or any suggestions that you may have for who we might get to quote about their opinion regarding those statements so that we could issue a response?
So looking for a public quote from the Board of Investments, you should reach out to David Ewer, the Executive Director. your call whether
Yeah.
that's worthy of a response or.
I think we can point to, and I have a draft written, and it's over in the hands of Impera. We may piggyback together and do a joint statement, but I think we can look at the historical performance, long-term, as well as, the last couple of years of performance and sort of squash some of those remarks rather quickly.
Okay.
But, yeah, sorry, I didn't get the draft done until sort of late in the day yesterday, and we are gonna try to do something.
I'm impressed you have it.
Yeah.
But, from my own opinion, I haven't read the article, but just because a plan is below 100% funded doesn't mean the plan is broken. It's not a problem. And people make a lot of, that is a number that is available of funding on a defined benefit plan like you have now. It's not as readily available on a defined contribution plan, but if you were to calculate a similar type number, it probably in most cases would not be as attractive as the funding you have in the DB plan, right? Because so it is, these numbers of saying how are you relative to what you think you need to be for a very long period of time. These are goals to strive for, and I believe over the longer horizon we will strive for them and we will achieve them. But it's if you're below a current goal currently, that doesn't mean there's problems.
Well, you're preaching to the choir. I'm quite sure that he just utilized that rhetoric and those numbers to create fear in the public and those politically motivated entirely.
Okay.
So,
Well, sorry I don't have more of a comment there. I'm going to try to stay out of the press as much as I can.
Yeah, spotlight there.
And but thank you again for your time. Sorry for going over.
Well, thank you. We appreciate
Very
it.
informative, thank you.
And so, what we will, it's supposed, by statute, this report should happen as soon as practical after the close of the calendar. It says calendar year, so we'll probably going forward, we'll look to do this in the February timeframe.
That'd be great.
Okay.
We'd love to do that.
Great, thank you, Joe.
Thank you.
thank you.
Thank you, Joe. That was very informative.
You're welcome.
Is there any public comment on his presentation?
Just appreciate the information.
Yeah. Well, thank you. Really appreciate your time, too. I know
Thank
you're
you.
busy.
Yes.
Have a good day.
Keep up the good work.
All right, John, we have the IT manager report next.
Morning.
Morning.
I gave you a couple of handouts. Each of you should have one. I'm going to start off though. It looks like last February it reported that we were just initiating what's called IT convergence, which is a migration away from TRS-owned IT assets to being hosted by the state's IT services division. And that was completed in the spring. And as of right now, TRS's IT infrastructure is almost 100% wholly hosted by the state's IT services division. What we do have as in owned assets for teacher retirement system are virtual desktop infrastructure, which are the devices that sit on people's desktops to allow them to access their virtual remote desktops. They're small appliances, and for the most part, we do have some workstations, but they're very small appliances. We have some in the boardroom here normally, but they're just a really small computing device that allows us to log into a virtual server host back at the data center and bring out the virtualized desktop. So we've got some printers, some scanners, the VDI hardware, and that's about it for TRS-owned asset now. In February last year, we completed our migration to ITSD hosted infrastructure. And in March, we pulled out all of our TRS-owned assets. We sent it over to the Department of Administration's General Services Division surplus warehouse for liquidation. And since we've been running now for close to a year on a fully hosted environment, our uptime has been right around 99%. We've had a couple of outages. One of the outages we experienced was just last month, would have impacted us regardless of whether we were running on our equipment or ITSC's. It was a network-wide outage, so we wouldn't have been able to get to our own equipment, so it really wasn't a factor of us being hosted by them. It was a fact that the state just had an outage. So performance has been good, uptime has been good, which is what the idea behind this convergence is, to get everybody running on the same infrastructure and to improve performance as a benefit for state agencies. As part of that convergence, one of the other requirements was for us to migrate away from our content management system, which we've been using IBM FileNet for years here at Teacher Retirement System, and moving to Perceptive Content, which is an enterprise it's an enterprise solution that does the same thing that the state has purchased. And we are, as of right now, we're in process of making that migration. Sorry, my notes here. In January, last month, we delivered test migration of 2,500 documents to Perceptive Content from FileNet, and set it up as a proof of concept, so we can do some testing, see what it'll look like, see how the system functions. And with those documents in there and metadata available in the test Perceptive Content environment, we started working to develop new business processes that's going to work with Perceptive Content. Most importantly, the interface between Perceptive Content and our mTrust pension management system. Our contractors, AMA, through a product enhancement, developed some functionality in mTrust that allows us to interface with mTrust, and then Rex, our network administrator, has done a significant amount of design and configuration work to get mTrust and Perceptive Content talking to each other, and we anticipate it's really going to expedite and make far more efficient the method that we get content into our content management system. So we're looking forward to that. In February, just this week, we delivered another batch of 4,000 documents and metadata to ITSD to load into that Perceptive Content system. This 4,000 document batch represents content from people that have retired since July. And the idea is that all of our staff are familiar with working with these documents because these are recent retirees. And as soon as that metadata and documents are loaded into that test environment, our functional teams will be able to come in and actually start hands-on testing with Perceptive Content to help us with the development of business processes and get our staff familiar with what Perceptive Content is going to look like, because it'll be a significant change for people that have been using FileNet for so many years. We do not currently have a production migration schedule, but we're right now anticipating either mid-spring to early summer, forecasting us to do an actual migration of production over to Perceptive Content. One of the handouts I gave you, this one here, is a visual diagram of a source code repository. TRS deployed Windows 2012 server just at the end of last quarter, to host a source code repository. The software that is running this source code repository is Apache Subversion. It's version control software, and the idea behind it is that all source code is held into the repository and is managed so that changes and modifications to that source code are tracked historically, so we can go back and see all the changes and who's made them over time. And the reason this is important is without a source code system, our source code we have source code sitting on all of our servers, the web servers and application servers. It's also sitting on our developers' desktops, our contractors' desktops. And at any given time, we may have multiple versions of the same piece of code sitting in different environments. And we run the risk, because if we lose the code in one spot, that we try and replace it from another spot, that it's not the same version that we had originally. And so the idea behind the source code repository is to do tracking. It's a file cabinet for source code, and every time somebody touches it or works on it, they have to check out a piece. And when it gets checked back in, we record who touched it, what changes were made, and if we don't like the changes that were made, we have the ability to revert back, and the system manages that for us. So in the diagram, the folders represent the working copies. AMA is our contractor. You can see that we've got folders for each of the developers there. We have a folder representing a TRS copy. Maybe we're doing some in-house modifications to code ourselves, but we have a checked out copy here. Repositories in the middle, and on the right side of the diagram, we have our application servers. And the numbers you see with the application servers, those revisions, basically represent the fact that our production application server will always be running what would be considered our stable release of code. And that's going to be some of the oldest code we have out there. It's stable. The development server down here is running the newest code. And the repository is managing all this for us. So on the development server, we have revision 301. It's the newest code. We're testing stuff. There may be bugs with it. We have to do some more work on it. As we make changes, code gets checked into the repository, gets pushed out to the development server. As this code becomes more and more stable, and we're more and more satisfied with it, we move it up into the environments until ultimately it hits the production server. If we ever hit something in production that we don't like, we can just revert the number back to a previous revision and put our source code. We can back it up to revision 1. At the touch of a button, we can go in and take our application mTrust production server and revert it back to any state and time in the past. It's a very powerful tool. We are ready to deploy this. We have the infrastructure in place. The server's deployed. A Subversion repository is up. We have a copy of the mTrust source code from January in there for testing, and right now our developers have access to it, and we're waiting to develop processes and procedures for how we're going to interface with it, rules, business rules that we're going to put in place on how and when we're going to manage this system. So we anticipate going live with this probably sometime in, I'd say realistically, in second quarter this year. I don't see it happening before then, just because it represents a significant change, so we're going to have some learning curve there. But it'll be from the standpoint of protecting the significant investment we have in our mTrust and our web application source code, this will be a big step forward in protecting that asset. The last thing to update you on was the TRS really is about recovery process, but we've produced a systems maintenance and recovery process document, which you have a copy of. And what that document details is a monthly planned schedule, including process and procedures for how we're going to maintain our application and all of our server environment here at Teachers Retirement System. We implemented this in last month for the first time. Next week we'll be going through our second iteration of this. But it's a procedural document that details the process that we'll go through, when it's going to happen, when server updates will happen, the sequence of which servers get updated, and what actual processes will be taking place, how those updates will be performed. We're going to update all the software. We're going to keep our software to the latest version. The idea here is we start off with our development servers on a Monday, see how things work Monday and Tuesday, or on Tuesday after the update. On Wednesday, we'll update our test servers and make sure everything's stable with them. On Friday, we'll do our staging servers. And over the weekend, if everything's fine, on Monday, our confidence that all of our updates are successful and that they don't impact mTrust, the TRS website, they don't impact our business practices, our confidence will be high, and we will update the production servers on Monday night. And so that's the rationale behind doing it this way, is to systematically move the updates through the least critical servers to the most critical servers. But an important piece of this is on the third page there. The rollback procedures is a detailed description and process for how we can recover. And this is applicable not only in case we have updates or patches that cause a problem on one of our servers, but in the event we have a failure or any other type of a software or hardware failure that we need to recover from. These rollback procedures provide us a step-by-step method for getting a server back online and into production in a rapid fashion. And so this is just it's some documented processes for some, it's not that TRS didn't have procedures in place, but they've never been detailed and documented before. So what we have now is an action plan that we can grab and go off of in the event of necessity there. So the last page It's just a diagram, a graph showing, listing all the various servers we have, and maybe surprising to know that we run as many servers as we do for such a small organization. But the idea behind having dev, test, staging, and production environment is so that as we're developing code, we're not touching any of our production environment. And that way if something blows up, it impacts the least amount of people possible. Any questions about any of this?
Speaking another language.
Well, that's what I thought Joe was doing.
Right? No, I think, about once a year, we have the IT manager present a report. I think it's a good exercise to go through, just so our board is kept, apprised of exactly how many things. There's a lot going on for a very small, a 2-member IT shop. I mean, you have, there's components of the Trust upgrade that affect, IT, as well as we just rolled over, like John said, completely to all hosted environments. So our hardware, we used to own and maintain ourselves, that's sort of different now. And then the imaging system, that going to Perceptive instead of FileNet. And then, just the server, there's just a lot. I mean, John just went through it, I won't restate it all. But like that server, or the code configuration management, that's a really important thing. And it's gonna cause us a little more time than it would otherwise for the project, because now you're gonna have sort of defined steps and roles, and who can do check in and check out. It's gonna slow things down just a little bit, but we have to do that because it's getting so complex with these 4 different environments that if you could be 1 click away from having a major problem where that code configuration will help. So anyway, I just wanted to add just a couple little bits that they are really busy. There's a lot going on.
Glad you're doing that, John.
Thank you.
Thank you for the information.
You're welcome. Thank you.
Right, we're on to administrative business. We've got an investment report. Do you have anything you want to add?
I don't think I could add anything of substance.
I printed some copies.
Oh, did you? Okay. We did get an update as of the end of January, the snapshot that I provided last time. We just got it yesterday, so Sean did make some copies if you want.
Oh, yeah. Oh, did I hand it
Yeah.
to you? I'm sorry.
Yeah, no.
Nice catch.
By the way, I thought that letter was very good.
Oh, yeah. I think during the executive director's report, I'll probably talk a little bit about that, but I don't know if everybody's had a chance to sort of read the draft. Jeff, did you?
I did.
Yeah, okay.
So Nolan, it's you next, the comprehensive annual financial report and your financial statements and budget.
Members of the board. So what we have, or you should have in front of you, hopefully you brought your CAFR, but it's not imperative. If you need one, I have like 2 extras is all.
Yes, please, I did not grab mine.
Okay.
One extra.
And we're not going to, obviously go through it line by line or anything like that. Basically, what the blue book says is this is the auditors, what they present at the legislative audit committee meeting here coming up soon. And it just says that we received an unmodified opinion for an A+, I guess. So that just tells you that our actual CAFR, you can rely on everything that's kind of said in there, and all the numbers that are presented in the CAFR. So they've given us a clean audit again. And just to kind of a brief touch up on it, so that you don't have to read the CAFR word for word by any means. The first couple, the first letter, to the governor is always a good thing to go through, and then the beginning of the financial section. It talks about the management's discussion and analysis is kind of a condensed version of some of the financial highlights of the CAFR. And then obviously page 18 and 19 are gonna be the statement of fiduciary net position and the statement of changes in fiduciary net position, which are the, kind of the, probably the main pages that any, legislator is gonna look at to see. And then if anyone has questions or you can obviously call me, on anything. If you have questions with these numbers, but they're also explained in a lot more detail in the notes that follow these. There's several notes to the financials and required supplemental information that is, follows in the CAFR there. So if you have any questions, though, feel free to let me know. I guess the highlights for June 30th of 17 are just that we received a clean audit again. We got our CAFR off to the GFOA for the certificate again this year, so we got that off in time. And we had a really good year, as Mr. Colin explained, in investment performance, so therefore our net position ended up really close to $4 billion, and so it's gone up, obviously. Was there any questions on the CAFR or the blue book itself?
Can I just say something really quick? So if you look at the very last, the back of the cover on the CAFR, it indicates that, these cost $35 a piece to print. Well, that's because it includes the design. It also includes the design work. So all told, with using Quick Mail Services design people to help us, craft this and format it and everything, it was $699. The per copy price is high because we only print 20 copies, but I just wanted to point that out. It's not, obviously there's not color photos or anything in here. It's not that fancy of a book, but there is some cost to designing and printing them.
Nolan, you haven't figured that part out too?
No, I'm not a computer genius. Darla has been helping me a lot with that.
Nolan, I have a quick question.
Sure.
I'm sure there's an easy explanation. On your page 19, under net investment income, it shows $427 million and change. And when Joe gave his presentation, under teachers, it showed a $407 million net investment return. So is the accounting period different, or does it have something to do? Is that
This is June, and the one over there is
December.
December
Oh,
31st.
okay.
Right, yeah, so these are all these numbers in the CAFR as of June 30, fiscal year, and what he was presenting, I believe, was as of December 31st.
Yes.
Yeah.
So, okay, thank you.
Yeah.
Calendar year.
Yeah.
So if there's no, obviously these, just I want, to mention, there's, as you flip through just really fast, the thicker, there's different sections of the CAFR, and it's, like there's the investment section that follows the financial section that, has a letter from Joe Colin, and it kind of goes through some of the rates of return as of June 30th and the different asset classes and what, so just if you're interested in any of the financial stuff or it has our management fees and things like that, the schedules, all that stuff. And then the next section is presented by, or put together by our actuaries, Kavanaugh McDonald. And that's the actuarial section that goes through a lot of our actuarial. And if you have questions on any of that stuff, let me know. The last section is our statistical section, and those last three sections aren't really audited by the legislative audit division, but they're required to be in the CAFR, so. And you can still rely on the information in there. No, it's not audited. So if there's no further questions on the CAFR or
Good job.
Well, thank you.
I like these.
I'll move on, I suppose, to the financials. And we did a little, I guess this is starting on page 53, if you're following along. We did something a little different, or I did, I should say. I did have Sean look it over. It's what I've done is taken the investment returns that are come from RVK as of December 31st and kind of tried to integrate those so that it looks a little more realistic, because like we said, and we've been talking about for the past several board meetings with BOI's change over to CAP, they're only gonna do certain accounting entries in Sabres, which is our accounting system, once a year at the end of the year. So in the past, we always could kind of see our progress in the financial statements that I present. Now we haven't been seeing that lately. So if you see on page 55, you'll see in the security gains, it's highlighted obviously the 224 million. What I've done is taken, our investments in CAP as of June 30th of 2017, and then our investments in CAP as of December 31st of 2017, and just use that number. So the difference there, obviously I've kind of planted that number in securities gains. So it's not a perfect one-to-one what you're gonna see, what you would see if they were still making the same accounting entries that they were, but we feel like it's at least better than not showing anything. So if you have any questions on that, but what that does is it shows that instead of having a very minimal securities gains in that column there, or that row, it'll show the investment revenue is at 225 million, versus what it would have shown like, just real minimal. And that kind of carries through over to page 54, you can see in our investment revenue, so therefore our total, revenue over expenses is a lot more in line with what it was last year at this time. And then on the balance sheet, it's all shown in that consolidated asset pension pool. It kind of takes the same number and plugs it into there, because some of that is like revenue where we actually have received dividends and things like that. But the majority of it is actually like appreciation of our stocks and bonds, and so there's no perfect way to show it on the balance sheet. But
on that page, Nolan, in 53, in the liabilities, the uncleared collections, is that kind of a timing thing, or is that more to do with the once a year?
It is. That's an account that's solely managed by Board of Investments.
Okay.
There's a and I'm not sure how they utilize that. It's always cleared out by the fiscal year end, and sometimes it's higher, like around this 20 million number, but it's not anything to be concerned about, because it's not like we owe that money or anything. It's just a clearing account that they use for I think they use it to rebalance their asset classes. So that's why, like last year it's at 35,000, and then this year it's at 18 million or 19 million. But there's really the other liabilities there are more, things that we have, and they're not even really things that we have control over. We really have very little liabilities on the books.
That was a company, because it was different, I assumed it had something to do with timing.
Right. And so you can see our fund balance is up over $4 billion now. Does anyone have any questions? Any questions on the financials?
Just real quick, so on 54 there, that is what we talked about last board meeting, where we're using these estimated revenues, and so instead of this showing up as a negative revenue over expenditures the whole year, we're putting those numbers in, just realize they're estimated, maybe slightly different, but they'll be pretty close.
I like that a lot better.
It does look so
You might want to
much
just put a
zero.
little asterisk on that, and then have a little
Explanation. Yeah, I can do that.
Just say estimated, that way we don't have to have this discussion every single time.
Sure.
Exactly, that's a good point.
It'd be better for the public too.
Yeah.
since they can't answer that question.
Yeah. We know, but not everybody else will.
And as we move forward, we may, because, some of this stuff actually should probably, these gains should actually probably be showing up in the short-term investment pool also, because we have the two pools. So, we may see what we can do there. But, as of now, this was kind of what we came up with thus far, so if there are any changes in the future, I'll let you know. Moving on to the operating budget, things are much tighter this year on the budget. We have as of December 31st, projected surplus in personal services about 46,000. However, we're projecting a small deficit in the regular operating expenses, which brings, we do have a projected surplus, but it's quite a bit smaller than normal, and we kind of thought that would be the case when when the last budget was approved in last May. We made things a little tighter, but we still anticipate having a surplus. It just won't be as big as usual, so. And the next page there is just kind of for the contract services, where we stand as of this point. That's just one of our larger expenditure categories. The M-Trust Phase 3 budget on page 58, also, projected to be, very tight. We have and it's because we extended this, the project a while back, and it may, we don't know if we may extend it again, but,
Well, it's very likely that we'll end up having to revisit the overall budget to the M-Trust project. Both Dan and Chamberlain and Dan Trost, I sent here a few weeks ago, since they're on the budget and audit committee, just a message. We're sort of renegotiating our long-term support contract with them, because now that M-Trust is built out, it's taking considerably more of their everyday time than they ever anticipated it would, to just maintain and support the existing. They agreed to a fee prior to that even starting on building the M-Trust project. So, long story short, and we'll go into it because I don't have any details yet, but long story short is that it's likely that we're going to need to ask for a budget amendment at some point in the future to increase the overall project, because the duration, it's not that we're asking for a whole bunch of new things or things that we didn't consider, but the overall duration of the project is going to be longer than we anticipated. And a lot of that's driven by, it's only a two-man shop on the development side. If there is significant support that needs to be given by them, there's only so many hours in the day. So just so the board is aware, that will likely be coming at some point in the future.
I guess I understand that, and I think they gave us a better deal than they should have initially. But if it's an agreement and a bid, is that our problem or their problem?
Well, we could take the hard line stance that it's their problem, but, what's to stop them from walking away, and then where do we sit? You know what I mean? Breach of contract, yeah, that's great, but that doesn't really do a lot for us.
It's obvious that what they thought was gonna happen in terms of their time, they were way off.
Right, so I think that original estimate was based on the level of everyday support that Alfred gave, to maintain and support Pension Plus. And so that's where that number kind of was derived. They knew it would be a little bit more, but they really didn't know how much more, because they agreed to that number before they ever started building M-Trust. Now that M-Trust is completely built out and continuing to expand through this enhancement phase, it's way more complex. And it's easy for me to see that it is way more complex than they ever anticipated. So I think even at the higher rate that they're asking for, we're getting a good deal, honestly. But
So that'll be a permanent ongoing expense of M-Trust?
well, it'll be semi-permanent. So it'll be at that higher rate for up to 36 months, and then we're gonna revisit it and look at the real statistics, because at that point, we should have a good 10, 12 months of the environment being really stable. And we can see what really did they have to spend hours-wise, and then we're gonna readjust it at that point, and then you'll have about another year left on the contract at whatever that lower rate is, and then after that, we would look to possibly contract with them for continued support, or maybe we might find that we're able to do most of it in-house.
That's what I was curious about, because with a two-man shop, we have some risk there that we lose, they lose one person, or.
Yeah, no, definitely, and that is, we do a risk registrar for the whole project, and that is, one of the highest risks on the whole thing is AMA availability, or if something were to happen to either one, those two, that's a big risk.
Sean, is that agreement with them is basically a month-to-month ongoing arrangement, or is it an annual contract, or?
So the contract we're currently in, we entered into about a year ago at this point, and it is actually through June 30th of 2022. Is that correct? Yep, through
So it's
2022.
going
So
to
it's a pretty
12,000 a
long
month for the next 3.5 years.
No, so what I've proposed back to them, and I haven't heard, they'll be here next week. What I've proposed is, because they've asked for the increased retroactive back to January 1st, and
Right.
so knowing, as we were just looking, our operating budget for this current fiscal year is tight. It was purposely tight. We tightened it up last year, so we didn't have these $200,000 and $300,000 surplus. We're trying to dial it in. So rather than go retroactive, what I've proposed is that we start effective July 1, and we still do it for 36 months, but it won't start until July 1.
I see.
And then after the end of those 3 years, you'll have about 6 months. It must be about 6 months. So it would be another full fiscal year at whatever that new rate is, because we'll reevaluate that new rate at the end of the 36
What
months.
Daniel brought up is pretty significant. If one of them, died or something, would we have is there a provision in the agreement with them such that we could renegotiate if something tragic like that occurred?
So they've provided a list of other programmers. I mean, hopefully they're not on the same airplane when it falls out of the sky,
Yeah.
right? So one of them at least hopefully would be available, and then they have identified some other individuals.
Tell them not to travel together.
I think there's clauses in there that we could, if need be, we can get out of that contract.
Well, there are, we can, if need be, we can get out of the contract, but the reality is that AMA is a one-person shop. It's Alfred Monksgaard's personal services essentially. So that's truly what our contract with AMA is for his personal services. Roy is a subcontractor that we've approved for the services. So if Alfred is no longer available to provide the services, frankly, the contract ceases to have any efficacy.
So, I mean, some of the, and that's a risk that we've known all along, and that's part of what really drove us to need to develop Entrust, because Pension Plus was built on such old code that we were in the same position. We had these same two guys, and if something happened to either one of them, that code was so old that you couldn't find somebody else. At least now it's modern, up-to-date code. You're not gonna have somebody with the level of expertise in the pension space that Alfred has right away, but they would be able to at least, write the code to make the changes we know we need.
Okay.
Yeah.
So they're probably advanced in code writing at this point.
Well, the actual writing of code, John can write some code, and I believe Rex has the capability of writing some code, and certainly the business expertise is coming from his staff here at TRS and primarily, yes. So we could, if need be, we could probably make small, I know we can make small adjustments right now, but in that capacity will improve as we get closer to the end of the project.
So this current budget is projected through January-ish of 2019. So almost a full year from now, but it's, like Sean was saying, it's likely that we'll need to come back. But this current budget is just through that January 19 timeframe. So the delinquent agency report on page 59, that was as of the 9th of last month, and these have all been submitted and posted since then, so really there's no delinquent agencies, nothing to speak of at this time, so that's all I have.
Thank you. Appreciate it. So we're on to our personnel committee report. This morning, we met with Sean and, Jim Cairns, thank you, to go through Sean's performance appraisal. And all of the board members filled out the evaluation, and 13 staff members. We felt really good about Sean's performance. Everything is above the outstanding criteria, above number 4. Sean felt like he got a lot of good feedback. And he was able to comment, and we were able to discuss everything. Really the only thing that came out of probably next year's performance appraisal will be that we'll probably take the GASB 67 and 68 out of his performance appraisal, because now it's an everyday type of thing. When we look at, for example, his competencies, board ratings, all 6 of us rated him. We ended up doing a final rating of an average between the staff and the board, but again, everything was above 4. So really, proud of what is being done. We don't want this to just be a good pat on back way to go. We want it to be a help to him. And I think that probably the comments are the most helpful. Because really, this is a pat on the back. It's really hard for us to say, well, you got to do this, because everything in there is looking really good. And
yeah, the comments that come back through the survey, especially the survey of staff and the board as well. But I mean, those comments is really what helps me the most, to see areas where I can improve, or areas it looks like we're doing pretty good. I think that's probably the most useful part of it.
And I just think, even from doing this for a number of years now with Sean, at the beginning, it was a lot of, okay, well, the communication isn't there, we're not hearing, we as staff members don't know what's going on, and that's not at all the case anymore. There's a lot of really positive comments about that. The communication is good with everything there, and so just everything is just improving, and like we were talking about, the honeymoon period probably really is over, so to see, no, but to see these scores still remain really high, it's awesome. Yeah, it's awesome. So we have an amazing director, and thank you for what you do. Do you have anything to add, Jen?
No. We're on track.
And like we talked about, your strategic plan, all those types of things are moving targets. So we'll just continue to monitor that and do what we can to improve. Thank you. Do you have anything to add?
No, like I said, I do probably get the most out of those written comments, because they're all submitted anonymously, so people really kind of write down what they feel. So that part of the process, I think, is good.
And like we said, 13 out of 20 people in the staff filled it out. That's pretty good. We offer, I couldn't remember what we offer, we offer a $10 gift card to Starbucks. We think we might have to up our ante.
Yeah, I think we're going to have to give them a little better carrot, maybe.
And for us, thank you too, but I know board members too, we fill it out, and sometimes it's hard, especially like when you're doing the staff or his supervision duty.
Yeah.
It's hard for us to know what, but so just take what you see, if you have any questions or comments or anything like that, you can always ask us, but
Well, we should
it's
just
good to
point
do
out,
comments.
we should just point out that his really high quality staff makes him look better.
That's right.
That's
There you
right.
go. Exactly.
Well, it's obviously a fine working Michigan, so we're pleased to be doing that. Always interesting. Tentative board meeting dates are next. I do have a problem with May 11th, and it's just my own personal thing. I have a graduation now that day, so, and I know that our actuaries are coming, so it will just be me, or unless there's anybody else.
So the only thing I would say is that that is the meeting the actuaries are coming to. It may be early enough that we can reschedule possibly if you want me to try to do that.
Let me point
It's up
out
to you.
that that's also the date tentatively scheduled for oral arguments on
Yes.
exceptions in the
I was
Brock.
just gonna bring that up. I just talked to the attorneys yesterday, maybe at that point.
I could probably do it via, because it's not, but it's in Coeur d'Alene, I won't be able to do everything.
Sure.
So I would certainly do, write in and Scott could lead the meeting and.
And again, that would only be in Zabraki, that's only potentially at this point oral arguments, so it's not final consideration of the determination and there's a quorum, even with you gone, so I don't think that's.
As long as everybody else. Scott, does that work for you?
Scott?
I'm not sleeping, I really am listening to all this.
Does May 11th work for you?
It does, however, we certainly would miss Carrie if she can't make it.
I haven't missed very many meetings in my years here, but I do have to do this. All right.
So do we want to keep it then?
Yep.
And if it's just me, I think that's,
See if we can get you to call in.
I will
Yeah.
definitely call in. That's fine. I can't imagine, I don't know what time the graduation is, but it wouldn't be at this time.
It's my wife's birthday, so I have to get home by dinner.
Okay, I'll keep that in mind.
And if something changes, you never know, I mean, I could figure things out, too. I'll let you know. All right, so now we have out-of-state travel requests as well, which is an action item, so we will need a motion for this one. It's for Sean first, Denise is first in there.
Actually, John. So
John.
PRISM is on page
PRISM.
60, that's the annual conference that our IT manager attends. The NCTR Directors Conference is on page 61, that's the one that I attend. I've attended the last couple of years. And then the final one is for Denise to attend the NAPA conference in June.
Does it need to be separate motions?
I don't think so.
I think if you wanted, you could make a motion to approve all of them at once, but these are all three conferences that we have budgeted for last name and we typically attend. If you have any questions about any of them, but John is here, so I guess he'd be the odd man out. Yeah, I can probably answer. I can probably answer.
Approval of all the requests for out-of-state travel.
Second.
It's been moved and seconded. Is there any further discussion? All those in favor indicate by saying aye.
Aye.
Chair votes aye as well. Any opposed? Okay. So our next meeting date is done already.
Yep.
Oh, there's just tentative as well. An opinion or an option for public comment again, Diane.
Well, you just hear from me a lot. I want to thank you all. And comment on John's performance, but I appreciate working with him, and it sounds like you all reflected the same type of working relationship that we see as well. I also understand the concern with the costs on the interest project, but I also know from watching other state agencies, you're doing pretty darn well. My final question, maybe during public comment, is where are we in terms of the percentage of the budget that we could be spending?
Overall, so,
Yes.
yeah, by statute, we're allowed to spend up to 1.5% of benefits paid out from the previous year. We're at about 0.75%, so about half.
Thank you.
Now, the interest project is, we did that as a capital project, so it's not counting against that. But even if it were, the way it's been spaced out, we would still be well under 1.5%.
Thank you.
And that was something that was brought up as well in his meeting, just if staffing is sufficient. And really our biggest problem right now is space.
Yes.
Yeah.
I'm still hoping for that external auditor, internal auditor position sometime to work with everyone so that we can early identify issues. I know everyone's working toward that too. Thank you.
So we do have time for break right now. Should we just shorten that a little bit? We're not far behind. Let's just do a quick 10-minute break.
Sounds good, yeah.
Okay.